Hi, everybody. Welcome to Payroll Specialist Fundamentals. And you can see my voice is starting to go, so I apologize for that. My name is Stacy Kildall, and I own and operate Kildall Services LLC. I've been using QuickBooks in one way or another, one form or another, since about 1990, since late 1998, and I've been a trainer for Intuit since 2005. I've had my own bookkeeping business. Technically, the LLC was started in 2005, but I've been doing it on my own since about 2003. So a really, really long time. Coming up on my 20-year anniversary. So you guys are going to get CPE credit for today. I'm not going to read this whole this whole slide to you. What you need to take away from this is that you have to be present for a minimum of 50 minutes in order to get one CPE credit. You also have to respond to 75% of the pop-up checkpoints that are going to show up in the environment that you see. There's going to be a bunch of different windows, and then I'm going to have a few polls for you to answer. The thing about the polls that I want you to keep in mind is that it's not about getting the question right or wrong, it's about participation. And after we do the polls, I'm going to tell you what the answer is anyway. So don't sweat getting the answers right or wrong. If you have any questions about CPE, you can go to the CPE help desk here in the lobby of the VCon, or you can email accountant_training@intuit.com. Now, one of the things that I want to mention before we move forward is if you're not seeing something, what you can do is all of the boxes that you see on your screen in this environment, you can move them around and or resize them. So if you want to have the video, which I highly recommend, you can close it all together, or you can make it really teeny tiny. So usually when I do these and I'm watching these, and even when I'm presenting them, the video is wee tiny little box up in the corner, and then I want to see the slides nice and big. So you can rearrange them however you'd like. So I just wanted to give you a heads up on that. And you see the little checkbox in each one of the boxes, the little X mark in the top left, and you can close those and then just click the icons to reopen them if you need to. So that's about CPE and a little bit about maneuvering through the environment. We have some additional resources. We have qbtrainingevents.com, which lists all of the free training that Intuit offers. It may be where you found out about this event. We also have the Firm of the Future blog. This is a great resource for product updates, as well as soft skill practice management things. And then we also have the Intuit Marketing Hub, which is a bunch of resources that are available for us so that we can get the word out and let our potential clients know that we are here. If they don't know we're out here, they don't know that they can hire us so that we can help them run their business. One of the things that I do, we have a bit of a disclaimer that I want to mention before we dig into stuff. So this, it's really important for you guys to understand that this presentation really is for educational purposes only. The information shared may change in the future, and so you are always going to want to refer to any of the sources or the links that are provided for the most current information, whether that is, the federal government about federal payroll rules, or your state and local resources as well. So you want to make sure that you stay up to date, because this could change tomorrow. They might decide to change stuff. So we have a big agenda. I'm going to just tell you this session is a fire hose of information. So don't worry about, absorbing all of it right now. That's why we have handouts. And this presentation will be available on demand after the event concludes. So you can always come back and review these, if you need to. So I'm not going to list all of this. We have a bunch of stuff that we're going to talk about. And one thing I do want to call out is I'm not always going to be looking directly at the camera, because I'm going to be looking in different places for some of my notes and, just making sure that I get everything that I need to cover in this content. So that's why I always make my camera angle or my screen real short, because I don't like to see me not looking at the camera, but that's just me. Maybe I'm a weirdo. Okay, so the first topic is basically we're going to just understand what a payroll specialist is, and any of the essential tasks that a payroll specialist may need to perform for their clients. So what is payroll? It's how employees get paid. It is the compensation that a business has to pay the people that work for it, over a set period of time on a specific date. It's usually managed by someone that you may have an outside, it may be outsourced to a payroll specialist or a payroll company. It may be done in house. Regardless of where or whom happens to be processing the payroll, there's always going to be someone within the organization that is kind of managing, collecting all of the new employee documentation, gathering up the hours, any benefit information. So there's always going to be someone who is kind of in charge of that, whether it's an HR director or maybe the owner, or possibly someone in the accounting department, or there may be a specific payroll department, depending on how big the company is. So payroll can also refer to a company's employees and the amount of compensation due to each one of them. It's a pretty major expense for most businesses, and it's almost always deductible, meaning that that expense can be deducted from gross income, lowering that taxable income for the company. Payroll can offer, or can differ, I should say, from one pay period to another, maybe because of overtime, sick pay, bonuses, or any other variables. So the role of a payroll specialist, I think that there's not really any specific requirements, like you have to pass your CPA exam to be a certified, to be a CPA. But with a payroll specialist, I have a high school diploma, but I do not have another degree. But I have been doing payroll since I was in junior high. My dad owned a business, and so I would help him with his payroll way back in the day with the big manual charts to see what the deductions were going to be. And we did all of that payroll manually. So it may be preferred. This states that a minimum of 5 years working in payroll or a similar field. And really, I think a specialist really should have that depth of knowledge. They should have that experience. But just to be a payroll processor, you have to start somewhere. And like I said, you should have at the basic a working knowledge of pretty simple accounting principles and also some payroll best practices. So the specialist really has been working with payroll for quite a while, and they have maybe some different, if experience in different states, running payroll in different states as well. And they may also have a specialty or expertise in a specific payroll software, which there are lots to choose from. I prefer Intuit's, the QBO payroll, because it's all right there. Because we only work with QuickBooks in my firm. When clients ask me to do payroll, I only say yes if they're using QuickBooks Online Payroll, because it's all right there and I don't have to log into multiple programs. So some of the responsibilities of a payroll specialist, I mentioned this before, they're going to be collecting, timesheet information, payroll information, the new payroll documentation that is necessary. It may be actually entering the data into the payroll software, calculating the wages, benefits, tax deductions, commissions, things like that. I will say I have not manually calculated payroll in probably 25 years. The software, there's so many good pieces of software that will do that for you. However, I have yet to find a really good commissions calculator. So a lot of times, one of the things that we're manually calculating are any commissions or bonuses. They may also be responsible for preparing and processing the paychecks, as well as any of the tax filings or payments, the liability payments. They're going to be responsible for maintaining accurate records of payroll documentation and all of those transactions, and then possibly preparing and distributing any income statements that are related to that. They're probably going to have to respond to any payroll-related inquiries and resolving any of those concerns. I just had a situation a couple weeks ago where I have a landscaper, and he had one of his guys leave and then come back. And I said, "Is everything the same, the direct deposit?" Because I just made him active again in QuickBooks Online Payroll. And he said yes. And he asked the employee, and the employee said yes. And then it turned out that he was using, I don't even know, but whatever with the paychecks. Um, he didn't think he had the account set up and it was still active, but it was still set up and direct deposit. And so he was telling his boss, "Oh yeah, I didn't get my direct deposit." So the my client was handwriting checks. The guy was getting double paid, but the employee didn't even know it. So, that was one of my responsibilities as the payroll specialist, is to kind of troubleshoot that and come up with a plan to sort of rectify that. So it's that kind of stuff that you're gonna have to deal with. And then all sorts of other stuff that you're never even gonna think about that could happen, just FYI. Um, it's possible that you may have to prepare financial statements or pull reports, maybe for any accounting, or maybe, a workers' comp audit or something like that. And then it's possible that you may be asked as a payroll specialist to create some payroll reports for review by the owner or by other administrators. So the payroll process, it's really important to understand what the process is. And so the first thing, the first and foremost, I think the most important thing is to define a payroll policy that states what benefits, leave policies, you know, uh, leave, any other related items. You want to define any of the components that are going to appear on that pay slip per that policy, and in compliance with any federal, state, local regulations. You want to obtain and record the employee details accurately. This includes any bank account details, tax details. Make sure that you validate those employee inputs as well. You're going to want to calculate the statutory as well as the non-statutory deductions and deduct them to arrive at the gross pay amount. You want to pay that salary, so you pay the salary amount to each employee through whatever mode the company employs. Most often, I've mentioned, this is going to be done by, with the bank, and the salary amount to be dispersed to each employee account. You're going to want to record that payroll, the payroll transactions in the accounting system, and then pay dues to any appropriate authorities. And by dues, or I mean any payroll taxes that are due to those authorities, and file the returns accurately and in time. So hitting due dates is really important. And then you're going to have to either physically or digitally distribute pay stubs and other relevant documentations to those employees. So that's the process, right? So define the policies, figure out how you're going to do the payroll, calculate the payroll, pay out the payroll, and then make sure that you're compliant in filing all of the liabilities, as well as the filing the returns, as well as paying the liabilities. So payroll, it can be, a lot of times it's going to be the biggest expense for a company, and it can get complicated. It can get a little bit messy, which means there's prone to error. So one of the things that I really kind of try to drive home with my clients is that I'm double checking and triple checking pay stubs before I send them, but I am also human, and sometimes there is a mistake. And so it's really important when I submit that or I get payroll done for them to review it to make sure that it is accurate. It's always good to have a second or third set of eyes just verifying the hours. Because everybody is human and we all make mistakes. So and if you have poorly managed payroll, and you're not paying employees on time, or you're not paying the correct amount, this is going to cause really big problems. You're probably not going to have those employees working, or the company's probably not going to have those employees working for them for very long. So just a couple of issues that are related to poorly managed payroll. The productivity one. This means that, like, they're going to be less motivated. The employees are going to be a lot less interested in making sure that they get their job done well and they get their job done on time. If they're not, if there's constant payroll errors. Um, Retention, like I just said, it's going to be hard to keep employees if payroll is managed poorly, if the hours are wrong, or the hours are late, or the direct deposit doesn't hit and when it's supposed to. The damage to reputation. So the poor performance and poorly managed payroll, this can really affect the business's ability to serve the customers. And so what happens here is related to that productivity and that employee retention is employees start to complain, and they start to complain to the customers. And so then the customers are less likely to come back. And then recruitment, it's going to be really difficult to recruit. Again, that damage to reputation is going to directly affect whether or not it's going to be how effective the company is going to be at getting new employees. And then also, I think the biggest thing, and the one that's most important to most companies, is it can cost them a lot of money. If payroll is managed poorly and the paychecks aren't getting done on time, that means that there's probably there's a high probability that maybe the form filings, the returns and the payments aren't getting made on time, and that's going to cost them penalties and interest. And nobody wants to have to pay more money to the IRS or the state. So we want to define some different types of employees. We're going to look at some key factors and criteria that are going to help determine whether an employee should be, or whether a worker, I should say, should be classified as an employee, a contractor, or a statutory employee. So worker classification, it's a systematic way to really define duties. It's very important, and this is, I think, a lot of us here are practitioners. It's the same. Defining job duties is just as important as when we define the scope of work for our clients. What is it that I'm going to do for the compensation that I'm being paid? And employees get really upset when they're asked to take on more and more and more that's not included in the job responsibilities that they agreed to when they took the job. So that's really important. And it's important to keep happy employees, but also those duties, responsibilities, the authority level of a position, they all have ramifications that are related to state and federal compliance, right? So it's going to determine if an employer has to withhold income taxes and pay, Social Security, Medicare, and pay employment tax on those wages to an employee. Businesses normally do not have to withhold or pay taxes on payments to independent contractors. I've had that happen one time, and it was because it was like they got a letter from the IRS saying that they had to withhold payment from this independent contractor because they were in arrears on their income tax. So the contractor was, but that's one time in, I don't know, 30 years. So the earnings of a person working as an independent contractor, those are going to be subject to self-employment tax. So generally, you're not going to be taking taxes out of a contractor pay. So the general rule to follow with this is that if the individual is an independent contractor, if they have the right to control or direct the result of the work, not what must be done and how it will be done. So small businesses really should take into consideration all of the evidence, the degree of control and independence. So for instance, when I first started, I didn't have my LLC, so they weren't hiring my company to do it. They were hiring me as a contractor. They were saying, this is what I would like to do for you. And then I got to decide how I was going to do it, when I was going to do it, where I was going to do it. So, and I mean, that was a million years ago, but you really need to figure out and make sure that you understand the difference between an employee and a contractor. So the IRS provides small businesses with guidance on how to classify this, and you need to consider a few things. The first is behavioral control. So a worker is a direct employee, which means they get taxes taken out, Social Security, Medicare, federal, state taxes, when the business has the right to direct and control the work performed by the worker, um, even if that right is not exercised. Um, these categories for behavioral control, it's going to be the type of instructions given, such as like maybe where and when to work, what tools to use, or where to purchase supply and services. Maybe receiving the types of instructions in these examples, they may indicate a worker is an employer. It's going to be the degree of instruction. More detailed instructions may indicate that the worker is an employee. Less detailed instructions reflects less control, indicating that the worker may be an independent contractor. Evaluation systems to measure the details of the work is done points to an employee. Evaluation systems measuring just the end result may point more towards an independent contractor. But it's possible that it could also be an employee. um, Training a worker how to do the job, or any periodic or ongoing training about procedures and methods, that is also pretty strong evidence that that person may be an employee. Basically, contractors kind of are going to work. Use their own methods and take care of their own training. The financial control, the question here to ask is, does the business have a right to direct or control the financial and business aspects of the worker's job? What we need to consider here is there a significant investment in the equipment that the worker uses in working for someone else? Are there unreimbursed expenses? Independent contractors are a lot more likely to incur expenses that aren't going to be reimbursed by the employer than employees. For instance, if I do a cleanup, maybe I do some work for a client and I'm doing 2 or 3 years worth of bookkeeping because they're behind on their taxes. The client is not going to provide me the computer to do the work. The client is not going to tell me and purchase the software that I'm going to use to maybe convert PDFs to a .qbo file or use an import tool. I'm going to do that. I'm going to bake that into my fee. I'm not getting reimbursed for that. So that might be one example of that. The opportunity for profit or loss is also an indicator of an independent contractor. Services that are available to the market. So basically, can I do this for multiple companies? Yes, I'm probably going to be an independent contractor. And the method of payment, an employee is generally guaranteed a regular wage amount for hourly, weekly, whatever other period, every 2 weeks, whatever the time period is. And even when it's just commission. So that commission is going to be paid out on a regular basis. Contractors are most often paid for by the job after they submit an invoice. The relationship. So you have to look at the type of relationship. It's going to depend on how the worker and the business perceive their interaction with one another. And this is going to include possibly written contracts, which describe the relationships that both parties intend to create. A contract stating that the worker is an employee or an independent contractor is not sufficient to determine that worker's status, right? Just by saying they're an independent contractor and then you tell them what days they have to work, where they have to work, you're providing the equipment, just by stating in the contract that they're a contractor, that doesn't make them the contractor. You have all of these other layers of stuff, the behavioral control, the financial control. Also benefits. So any business that is providing an employee any benefits like insurance, a pension plan, vacation, sick pay, those are going to be employees. Businesses generally don't give those benefits to independent contractors. I know that I've never been given sick pay by any of my clients. And then the services provided, which are a key activity of the business. So to the extent which the services performed by the worker are seen as a key aspect of the regular business of the company. So if I am a bookkeeper and I hire someone, I really have to look at even though they're doing it on their own time, even though I'm not telling them what to do, how to do it, if that's that is a key part of what I do. I'm a bookkeeping company. I really have to think about, they're probably an employee if I were going to hire somebody. And right now I don't have anybody working for me, but if I did, I would probably hire them direct, as opposed to hiring them on as a contractor. Some key questions to ask is decision making. Do their decisions affect the business's profit and loss? Um, do they make investments in equipment and supplies for the business purposes? Does the business set their pay rate, hours, and duties, or does the person working doing the work? So for me, as a company, I'm telling the clients, this is what you're gonna pay me to do this work. They can hire me or not hire me, but I'm not going to be an employee of that business. Doing bookkeeping is not a core part of a landscaping company. I'm not going out and doing the fall cleanups and, planting the trees and, doing the design. I'm doing the book, so I'm not a core part of that client's business. So it's fair to say, if I didn't have my business, then I would be a contractor. Do they have a permanent working relationship with that employer? Um, that's a big question right there. Do they use their own business judgments and skills? And do they perform work that is really a core part of the business? This is what I just mentioned. So those are just some questions to ask. I mean, like I said, this session is a fire hose. There's a lot of information. So the exception to this rule is statutory employee. And so a statutory employee is deemed to be an exception to that rule and is defined as being an independent contractor who qualifies for employee treatment only if any of the following applies. If they are a driver who might do beverage distribution other than milk, it's in my notes, other than milk, or meat, vegetables, fruit, or bakery products, or who picks up and delivers laundry, dry cleaning, if the driver is your agent or paid on commission. Right? So there's 4 categories where they're going to be a statutory employee. A full-time insurance sales agent, where the principal business activity is selling insurance or annuity contracts, or both, primarily for one life insurance company. An individual who works at home on materials or goods so that the business can supply that they're working with, they work at home on materials or goods that the business supplies, and they must be returned to the business. And the business is also going to give specifications for the work that has to be done. And the other one would be a full-time traveling or city salesperson who works on behalf of the company, who turns in orders to the company from wholesalers, retailers, contractors, operators of hotels, restaurants, or other similar establishments. The goods sold must be merchandise for resale or supplies for use in the buyer's business operation. The work performed for the company must be the salesperson's principal business activity. So one of the things there you can look up is there is a publication 15A. It's the Employer Supplemental Tax Guide. This is going to, you can refer to that for a lot more information about this. When we're talking about Social Security and Medicare taxes, you are going to have to withhold Social Security and Medicare taxes from the wages of the statutory employees if all 3 of the following conditions apply. The service contract states or implies that substantially all of the services are to be performed personally by that worker. They do not have a substantial investment in the equipment or property used to perform the services, other than an investment in maybe transportation facilities, and the services are performed on a continuing basis for the same payer. I know it's a lot. Go check out, again, that's 15, publication 15A. It's called the Employer Supplemental Tax Guide about statutory employees. So understanding employment classifications. So once you and the company, once you and your client have determined that a worker is an employee, you're going to need to establish what type of employee that worker is going to be classified as. There's three factors to consider when classifying employees in the workplace. One, the duties. At-will employees, so understand if the employee is going to be exempt or non-exempt. So exempt and non-exempt status, this refers to the qualification for inclusion under the Fair Labor Standards Act, the FLSA. So the other thing is hours. This is the number of hours per week. So that duty is the commitment, right? And then the hours are going to be the number of hours per week, whether they're full-time or part-time employees. And then the duration, which would be the length of the employment. Are they going to be seasonal, temporary, or possibly an intern? So the types of employment classifications, quick view on this, we have full-time employees. Full-time employees work more than part-time employees. Generally, full-time employees are going to, they'll receive benefits like health insurance that part-time employees may not. There are some companies that do provide their part-time employees benefits, but the definition of a full-time employee depends on who you ask. But I think for most employers, it's going to be they work for a 40-hour work week. It might be 38. Some companies might say full-time is 38 or 36, but basically the general rule is that it is a worker who's scheduled to work at least 40 hours a week indefinitely, right? And they are eligible for benefits. So the Affordable Care Act, this defines full-time employees as those who work an average of at least 30 hours a week. And on the other hand, the Bureau of Labor, the BLS, characterizes full-time employees as those who work more than 34 hours a week. So again, it depends on who you ask. I think the rule of thumb is about 40 hours a week. So when you're thinking, like, what are these different definitions of full-time employees mean for you or your clients? You have some leeway is what it really means, is the number of hours your full-time employees work. So if you need more hands on deck, you can consider bringing on more full-time employees, and you can define what would be full-time. It could be anywhere between 30, 40 hours a week. Part-time employees, they work fewer hours than whatever is defined as the business's full-time employee. And as a result, like I mentioned, they may not be eligible for certain benefits. But you could also have part-time with benefits, right? So you could say if you work, 20 hours or more, then you are eligible for benefits. If you work 0 to 20 hours, and that would be the part-time with no benefits, you're scheduled to work, 0 to 20 hours for a max of 90 days. And they're generally not going to be eligible for any benefits. Seasonal employees, so you may have different types of employees. If you we have a lot of seasonal employees. I live here in Michigan, so I have some landscapers. Some of our landscapers here, they do snow plowing in the winter, but that crew is going to be a lot smaller than in the summer when they're doing the work outside. So they may have 8 or 10 people working, from the spring until fall, and then in the winter they're going to lay those people off, so they're considered seasonal employees, and then they may only keep 1 or 2 people on to help do the plowing in the winter. You could have an on-call, so it could be when as needed, right? They could just be, hey, I just need you when I need you. And then we also have interns. So an internship, this is they're programs where students or other trainees hire for a period of time at a business to gain experience or skills. And unlike the other types of employment, internships aren't always paid. Although I just dislike that. If they're doing work for you, don't. I just I'm not a fan of unpaid internships. I don't like it. I think they're still providing a benefit for the business. If I were going to school, I don't think I would take an unpaid internship, but that's just me. Um, yeah, they're gonna, work without pay at a business to receive college credit maybe or experience. However, the business has to meet the Department of Labor's unpaid internship standards to be legally compliant. So make sure if you have clients who want to do unpaid internships that they're fully researching whether or not that qualifies. And then the other thing is at will employees. These are workers who are not obligated to continue working at a business. They can leave at any time. And a business is not obligated to continue employing an at will employee. They can let them go at any time for any legal reason. Most employees, regardless of the type, like whether they're full time, part time, seasonal, whatever, they're going to be at will. I say most of them. And then we're going to talk about the difference between exempt versus non-exempt employees. So employees within a business, they're going to be classified either as one or the other. Each classification has specific eligibility requirements with different types of workplace benefits, right? So the key difference between an exempt and a non-exempt employee is that non-exempt workers are entitled to certain protections under the FLSA, the Fair Labor Standards Act. This is a federal law that sets minimum wage and overtime requirements, and although it has evolved since its passage in 1938, one thing remains the same, is that employers must classify their employees correctly or you're going to end up paying some compliance violations. So exempt employees are exempt from the FLSA. Typically, they have to be paid a salary above a certain level and work in an administrative, a professional executive, computer or outside sales role. The Department of Labor has duties that can, or they have a duties test is what I'm looking for. It's like a little test that can help employers determine who meets those exemption criterias. So what does that exemption mean? What does exempt mean? It means that employers are not required to pay overtime to employees who are properly classified as exempt. They may, however, choose to compensate such individuals for extra hours through different benefits packages. So an example of this is, I keep bringing up my landscapers. If I have a landscaper who hires like a crew boss, he's got a foreman, and he pays him salary, he's not exempt because that's not an administrative job. It is not a professional executive job. And so even though that employee is salaried and is guaranteed the same rate, whether he works 30 hours or 40 hours, he also gets overtime because he does not qualify as an exempt employee. The salary amount usually doesn't meet that minimum wage. They're not a professional in the company. They're not an executive level. And so what we're looking at is human resources, maybe a CFO, maybe an in-house legal associate. So they're usually they're not eligible to receive overtime pay, and they're excluded from minimum wage requirements, right? So really think about that. Just because someone is on salary doesn't mean that you don't have to pay them overtime. And I have to explain this almost every time I have a new client who wants to do payroll and they want to do salary. It's like, that doesn't mean you're not paying overtime. That even though they're salaried, that means you still have to pay overtime when they do work over 40 hours. So beyond meeting the salary and earning requirements, there's additional role exemptions based on various circumstances. Again, outside sales employees and teachers are exempt from both minimum wage and overtime pay, which is such a bummer because I think teachers deserve that, but that's just my personal opinion. And then you also want to make sure that you check out the Fair Labor Standards Act website for any additional details about minimum wage, overtime pay, record keeping, youth employment regulations, all of that stuff. Non-exempt employees. Non-exempt employees are they're hourly rate employees. They have to be paid an overtime rate of at least 1.5 times their hourly rate. Um, they are usually not salaried, but however, that if they are salaried, that that salary is less than the minimum amount determined by the DOL, the Department of Labor, and you can check out that. And what does non-exempt mean? That means that they are entitled to a minimum wage and an overtime pay when they work more than 40 hours per week. Some states will require overtime after 8 hours per day. Other states, you can work that 40 hours a week, whether it's 8 hours for 5 days or 4 10s. But you're going to want to make sure that you know what the regulations are so that you're compliant in whatever state your clients are in. Non-exempt employees are generally they're hourly. I know this says blue collar. It's basically not an executive position, right? And they have to be paid time and a half. Let's see. I'm trying to think of some other things. It might be, they're basically non-professional roles, right? They may not have. It might be, unskilled labor, even skilled labor. Retail associates, servers, landscape crews, mechanics in an auto shop. Trying to think of anything else. I think that's it. So there are consequences to unintentionally, even if you don't mean to misclassify a worker, it can be it's going to cost money. That can happen to any business. So you want to make sure that you take the right, you research that, you and your client research how the employees are going to be classified at the beginning. And so those penalties can be avoided. So there is, first of all, like, how do they get caught? Like, that's one of the biggest questions that my clients are going to ask is, how would I even get caught as an employer? Most of the time, it's going to be the employees who a worker believes that they've been misclassified or whatever it is that they're going to file a complaint, either with the state DOL, the State Department of Labor, or the US, the Federal Department of Labor. Another way is possibly when a worker might have been classified as a contractor and they go file for unemployment, or they're injured while working or driving for work and they try to get a worker comp claim. So those are, I think, the most common. My experience is that it's been complaints. I will say every employee or every client that I have had that has gotten in trouble with non-compliance for payroll, it has been because of a worker complaint. So state and federal government agencies, they perform audits as well. Looking for workers who may have been misclassified as independent contractors. Both the Department of Labor and the IRS, they focus audit work on contractor misclassification. A DOL, like a Department of Labor or an IRS audit, is going to typically include all of the employees and independent contractors for a 3-year period. I can't remember the last time I saw a client get audited, but I did have a client go through a state payroll audit. And it was easy breezy because we're all compliant, and it was super easy because we made sure we did our research before we hired everybody, and it was surprisingly painless. I just want to say we just emailed some reports, answered some questions. It was all done via email, and it went very smoothly. So what happens is, if an employee, the ramifications, like the consequences, can vary depending on whether the Department of Labor and the IRS determine the misclassification was intentional or intentional, or even fraudulent. So I think the estimate is like, I don't know, like 3.5 million, somewhere between 3.5 million, where the workers are misclassified as independent contractors when really they are employees. And I have a lot of clients that come to me and they say, well, can I pay them as a contractor? And I go through and I ask them specific questions and I tell them, no, you can't. I know you want to try and save some money on paying the taxes, but really this is an employee. And down the road, it's going to be cheaper for you than if you have to go through an audit and pay me or your CPA to help you through some kind of payroll or employee audit. Um, the consequences are there's going to be a $50 fine for each form that the W-2 or that the each W-2 form that the employer failed to file because they were classified as an independent contractor. And I just had this happen to a client who was not doing things right before they came to me. And one of the reasons why he hired me to do his payroll was because all of this happened. He was paying actual cash money to a worker, and they tried to file unemployment, and they filed a complaint because they had been paid cash. And so what happened is that the IRS and the state both came back and looked at him, and they went back, I don't know, like 3 years, 5 years, and he had to file. He just got hit with so much. It cost him so much money. And if he had just hired the people and put them on payroll, it would have saved him all that time and money. So since the employer failed to withhold income taxes, the business is going to face penalties of 1.5% of the wages plus 40% of the Social Security and Medicare that were not withheld from the employee, and 100% of that the matching Social Security and Medicare, aka FICA, taxes that the employer should have paid. Interest is also incurred on these penalties daily from the day that they should have been deposited. So any failure to pay, or I should say a failure to pay taxes penalty equal to 0.5% of the unpaid tax liability for each month, up to 25% of the total tax liability. It's going to cost a whole lot of money. So if there's any doubt, just put them on the payroll. It's a lot easier, right? Some of the other things that are going to happen, if it's fraudulent, if it's found to be fraudulent versus just like, oops, I didn't know, the IRS suspects, if they suspect fraud or intentional misconduct, it can impose additional fines and penalties. So like if, for instance, the employer could be subjected to penalties that include 20% of all of the wages paid plus 100% of the FICA taxes, both the employees and the employers, which means if for 5 years an employer paid them as a contractor and they did it knowingly, the IRS can come in and say, you know what? Not only do you have to pay your portion, the employer portion of Social Security and Medicare, you also have to pay the employee's portion of that. So criminal penalties of up to $1,000 per misclassified worker and 1 year in prison may be imposed as well. In addition, the person responsible for withholding taxes could also be held personally liable for any uncollected tax. I have actually seen this happen. I had a small business owner who I was working with just doing training. I wasn't doing their books or payroll, and they ended up completely going out of business because they weren't classifying some employees correctly. They also were not paying the payroll tax liabilities, and the IRS came in and cleaned out that that dude's personal bank account. Just came in and put a lien on all of his personal funds to pay everything off. So criminal penalties of $1,000 per misclassified worker and 1 year in prison can be imposed as well. I kind of mentioned that. Okay. So it's time for a poll. Which of these protections are non-exempt workers entitled to? They must be offered medical insurance, must receive their paycheck within 5 business days of submitting their time card, must be paid an overtime rate at 1.5 times their hourly rate, must be offered over or paid time off. I'm going to mute, give you guys a moment, and take a sip of water. All right, so I'm going to close the poll in 3, 2, 1. And the answer is they must, non-exempt workers, you must pay them 1.5 times their hourly rate. Okay, so complying with the FLSA, we're going to talk about payroll regulations outlined in the Fair Labor Standards Act. So Payroll compliance, this refers to the necessary steps that every employer must take to ensure that all tax regulations, wage and hourly rules, and the requirements are followed. Um, Observing federal and state overtime rules and more. So there are payroll compliance means adhering to all federal, state, local regulations that govern how employees are paid. Employers not that violate any of these laws may face penalties that could negatively affect their bottom line or even put them out of business. But by learning how to navigate payroll compliance, employers can help avoid tax trouble and maintain that positive workforce morale. Um, so the laws that govern payment are extensive. So in addition to the various state and local regulations, some of the federal legislation that employers should be aware of, the FLSA, that Fair Labor Standards Act, the Federal Insurance Contribution Act, that's the FICA tax, right? So that's Social Security and Medicare, federal unemployment tax, and then any other kind of payroll tax. These are all designed to prevent wage discrimination, based on EPA. The EPA requires employers to provide equal pay to men and women who perform their jobs in the same workplace. There's the Davis-Bacon Act. Like there's all sorts of other stuff that you should know about. So make sure that you are really in compliance, and don't forget not just federal and state, but any local tax that you may be responsible for. So the FLSA establishes a minimum wage. It establishes overtime pay, record keeping, youth employment standards affecting any employees in the private sector. And the minimum wage is set at $7.25, and that was effective July 4th, 2009. Many states have their own minimum wage laws, so you want to make sure that you're in compliance not with federal, but also with the state. So it may be different in the state. If your state doesn't have a set federal or minimum wage, then you go with the federal. So, like I said, minimum wage is $7.25 an hour. It was effective July 24th, 2009. So we really should maybe raise that. And then again, there are 45 states that have adopted a minimum wage higher than $7.25. So you want to make sure that you check out what the state minimum wage is. And if you have clients that have employees in different states, you're going to have to make sure you comply with each one of those different states. And then overtime, unless it's specific, the employee is exempt, employees covered by the Act, by the FLSA, must receive overtime pay for hours worked in excess of 40 hours. And it has to be 1.5 times. And there's a link here where you can go check that out if you need to. Standard work week and the hours worked. By definition, a work week is a period of 168 hours during 7 consecutive 24-hour periods. It can start any day of the week, Sunday to Saturday. You can go Wednesday to Tuesday, it doesn't matter. And any hour of the day established by the employer. Hours worked is going to include all the time that the employees must be on duty at the employer's premises or any other place of work. So the FLSA child labor provisions, they protect educational opportunities for minors and prohibit employment in jobs and under conditions that may be detrimental to their health or well-being. So I'm not going to read all of these, but basically 14 and 15-year-olds, they can work outside school hours in various non-manufacturing, non-mining, non-hazardous jobs. 14 is the minimum age for most non-farm work. 16 and 17-year-olds can work any non-hazardous jobs for an unlimited amount of hours. And 18 years old and above, they can work any job, hazardous or not, for any number of hours. These are just the very, you have to understand minors of any age can be employed by their parents in any occupation on a farm owned or operated by their parents. These are all of the specific rules for those agricultural jobs. You can take a look at this later if you'd like. I'm not going to go through each one of these. Payroll record keeping, this requires, it's exactly what it says. It requires employers to keep records on wages, hours, and then other items specified in those labor regulations. And there's a link, that fact sheet number 21, there's a link on the slide where you can go check that out to see what those record keeping regulations are. Some examples of what is required to retain. You have to, the employee's name, social security, basically their basic information, um, total wages paid each week. I know you can't really see it on the slide. It's a little goofy, my apologies. But the rate of pay, how many hours they worked each week, um, and then any overtime, um, the date of payment, when they started, when they were fired, basically all the basics of that employee while they were under their employment. So this next topic, understanding payroll compliance beyond the FLSA, that's what we're going to talk about now. We'll explain any of the regulations and how to meet certain IRS regulations and stay compliant. And we'll talk about the rules of business owners employing their families as well. So there's a lot to consider when business owners are employing their family members. And so you just really want to make sure that you're compliant. And this goes beyond that FLSA Act there. So how business owners pay themselves, it's going to depend on the structure of the business, the stage of the business, how much they need for personal expenses. Business owners can either take a salary and a draw or distributions of profits for any amount they want from their business. So you want to make sure that you understand between a draw and a distribution. It's significant and it's different for tax reporting. If you are not a tax preparer, you may want to make sure that you talk to the tax preparer before you and your client decide how you're going to paid. It's noting that the difference between taking a draw and taking a distribution, it's a common question that clients are going to have. A sole prop or a single member LLC, they can draw money out of the business. It's called a draw, and it doesn't show on the tax return. A partner's distribution or distributive share, on the other hand, must be recorded using a Schedule K, and it shows on the owner's tax return. So in the same way, a partner or a multi-member LLC and an S corp shareholder take a distributive share, that amount is going to be recorded on the schedule on the K1 as well. So really, basically, if they're a sole prop, this is a chart. I'm not going to go through all of this. This is how each sort of business entity is going to pay the owner of the business. So how do they pay themselves? Sole prop, single member LLC, they're going to take as draw. They're not going to be on payroll unless they have filled out the forms and told the IRS they want to be taxed as an S corp. All right, so you guys can go through and look at this later. When you are considering hiring or employing family members, payments for the services under a child who's under 18, they're not subject to Social Security and Medicare taxes if the trade or business is the sole prop or a partnership in which each partner is a parent of the child. Payments for the services of a child, if you hire your kid and they're under 21, they're not subject to federal unemployment taxes. So if they are subject to income tax withholding if it's a corporation, it's a partnership, and an estate, even if the estate is of a deceased parent. So you can take a look at all of this later. I know there are some I know some CPAs who are doing advisory work, and they're advising their clients to, you can save, money, you can put your kid on the payroll and have them work for you. You won't have to pay Social Security and Medicare. So understanding the different types of payroll records. Payroll records, they're pretty important. You have to have, and they have everything to do with having an employee. So you have to keep all of those payroll documents and records for every employee, as well as the business payroll records as well. So you want to make sure you keep it all, right? So they have to maintain, and it's part of the FLSA, they have to contain basic records that pertain to each employee. It's really important. It doesn't matter if it's paper or it's digital. It's important to only authorized individuals have access to that, right? And this is some of the information like birth date, time, day of the week. Like we mentioned before, you got to keep all of that stuff. Business owners and payroll specialists should have a employee handbook. These are super easy to get. You can download templates and set them up, or have your client set them up. It's pretty easy. It just includes policies, culture, legal requirements, any benefits, performance standards, any additional resources. It's always good to have an employee handbook, because if something happens and there's any legal issues, and the client, the employee says, well, there's no handbook, I didn't know that. It's really handy to have an employee handbook. There's other necessary policies that should maintain to protect the business. You want to have the policies should ensure the intention and secure the safety of the employees. You want to have written policies. They have to be communicated, and they have to be non-discriminatory. Employment and tax forms. There's various documents that should be obtained for the hiring process. First one, I-9, employment eligibility verification. This just, on the form, the employee has to attest to his or her or their employment authorization. They have to present certain documents to prove that they're eligible to work in the United States. We have to have a W-4. This is the federal withholding certificate. This is telling the employer how much withholding to take out of their taxes and pay to the government on their behalf. And then you may or may not have a state version of a W-4. Some states do not have withholding. So there's several other documents, and they all have to be held for a minimum of 4 years. So we're talking about W-2s, W-3s, 940, 941s, or 944 if that's what they file, and then any of the other state filings as well. So your state quarterly returns, your state whatever, local as well. So those have to be held for four years. I have clients who keep it all. They've been in business 17 years and they have everything. The retention requirements, employers have to retain all payroll records for a specific set amount of time to avoid any penalties. So you have to, for 2 years, maintain records that show how you determined the wages. So timesheets, things like that, wage rate tables, work and time schedules. For 3 years, you have to maintain records that pertain to payroll records, right? And then the maintain for that one, that would be like payroll reports, payroll calculations, employee files, things like that. And then for 4 years, your tax information. So all of your quarterly filings, your annual filings, anything like that. You have to keep that for 4 years. Oh, and we're already to another poll. So what is the purpose of a Form W-4? I'm not going to read this to you. I'll let you take a minute and answer this, and I'm going to mute and take a sip of water. Okay, so I'm going to close the poll in 3, 2, 1. And a W-4 determines how much should be withheld from the employer's paycheck for federal income tax. So calculating gross wages, I'm not going to spend too much time on this, but you need to determine, basically you're going to, and there's a lot of links again to those fact sheets that you can go take a look at. You're going to need to understand the different types of pay, how to determine the proper pay schedule, and calculate the right amount of gross wages depending on that employee's roles. These are just, you have to determine what the pay schedule is going to be, whether it's weekly, biweekly. And biweekly is every 2 weeks. Semi-monthly would be like 1st and 15th, 15th and 30th. Monthly, quarterly, annually. So you're going to have to figure out what the pay period is going to be for determining the type of employee. You have regular wages. These are going to be your salaried or your hourly rate that you're paying your employees. And then we have supplemental wages. It might be a bonus, maybe severance pay, any commissions, sick or any PTO. And then if your employees get paid tips. A work week is, again, a period of 168 hours that falls within 7 consecutive 24-hour periods. Again, can appear on any day of the week. So you just have to figure out what that work week is going to be. Calculating gross pay for salaried employees, you're going to put in the annual salary divided by the number of pay periods. That's going to equal the gross pay. Every software does that for you. So you just put in how much they get paid per year, if they're salaried, or week, and then the software will do it for you. Calculating gross pay for hourlies, it's very simple. Hourly rate times the number of hours worked equals that gross pay. And gross pay means what they're getting paid before any taxes are being taken out. We're just cooking with gas here, right? We are just moving. So this next section is understanding payroll taxes and any workers' compensation. So payroll taxes are part of why employees' take-home pay is less. So that's going to be their net pay. So they have their gross pay, any deductions, whether they're tax or benefits, and then their net pay. So there's employee paid payroll taxes, which is federal, state, local income taxes. And then there's employer taxes, which is going to be unemployment, federal, state unemployment. And then there's taxes that both the employee and the employer pay, and that may be Social Security, Medicare, workers' comp, things like that. So different types of taxes. Each employee is responsible for paying all of their federal income taxes, and if applicable, state income taxes as well. Not every state has federal or state withholding. And then depending on where they're located, they may have local withholding as well. From an employer standpoint, every employer is responsible for paying all of the federal unemployment taxes as well as any state unemployment taxes if those are applicable. Those are used to pay employment compensation to workers who have lost their jobs. Both parties are responsible for Social Security, Medicare, and then the additional Medicare tax, right? And then just to recap that, you can see the different rates of each one of these. Don't worry about memorizing these. It's a really easy Google search. You can go look them up if you need to. But again, the state unemployment, it's going to vary with each state, and then within the state, it's also going to vary. So I know in the state of Michigan, it can go as high as 10% if you have a lot of like layoffs or a lot of claims. If you don't have any claims, it's gonna be lower. So workers' comp insurance, this helps protect businesses and the employees from any financial loss if an employee is hurt on the job or gets sick from a work-related cause. So this could be workers' comp, might be workman's comp. You're going to hear it called a bunch of different things. If you have employees, you're required to have this. Again, training disclaimer, we want to mention this again. It's intended for educational purposes. It doesn't replace any independent professional judgment. Small business owners and the payroll specialists should consult with their plan administrators or an expert to understand any benefits. And so that's why we bring that up. We're not telling you what benefits to offer. We're just telling you some of the things that you need to know about some of those benefits. So when we're talking about payroll deductions, we have mandatory deductions, which are going to be any of your FICA, that's your Social Security, Medicare, federal, state, local income taxes, any wage garnishments, child support, anything that the court has ordered as a garnishment. Then there are voluntary deductions, which might be health, disability, retirement plans, job-related expenses. You also have pre-tax deductions, which might be medical, 401k, life insurance, and then you have post-tax deductions, which again, those may be the wage garnishment. It could be union dues, things like that. So anything that is not a mandatory deduction, you have to have in writing permission from the employee to take those out. So involuntary deductions, these are mandatory deductions, income taxes, any garnishments, court-ordered garnishments, whether it's student loan payments, child support, bankruptcy, whatever. These are involuntary and they are required by law to withhold from your employee's gross pay. If you do not do that, they could bring civil action against your business, and they may be liable for any attorney fees, costs of the lawsuit, or any punitive damages. So it's very important to make sure that not only are you doing these mandatory deductions, but you're making sure they get paid to the appropriate agencies to which they're owed. The maximum amount of money that can be garnished from an employee's paycheck, so these are court-ordered garnishments, is 25% of the employee's disposable earnings, or employee's disposable earnings that are greater than 30 times the federal minimum wage. Almost every garnishment form I have ever seen has a form on the back that that helps you calculate. And if you have any problems, you can always call the court and have them assist. I've never run into problems, and they're always really helpful because they want everybody to get it right. They don't want to have to come after anybody. Then there are voluntary deductions. These are not required by law, and you must have written employee consent to do them. This would be any health, disability, life insurance deductions, any retirement plans, union dues, or possibly any other job-related expenses. For instance, I have a client who will purchase a phone for the clients, for the employees. The employees get to keep the phones, but the employer pays for it, and then they just take out a small weekly fee if the employee wants. Again, you must have a written agreement. The employee must sign if they want to have those voluntary deductions taken from their paycheck, right? Okay. Then we have pre-tax versus post-tax deductions. Those are exactly like they say. Pre-tax are taken from employee gross pay before the taxes are calculated and withheld. It could be like benefits, 401k, group term life insurance. Post-tax deductions are taken from an employee's net pay after all the taxes have been withheld. This is going to include maybe any Roth IRA, union dues, or and those wage garnishments we just talked about. So understanding some payroll benefits, there's different types of benefits, a wide range of benefits that small businesses can offer. I think, should always consult with an expert to determine which benefits are going to be beneficial, whether it's health benefits, disability, retirement plans, any other benefits. Find a benefits administrator or somebody who does this for a living. If you're not familiar with it, I'm not an expert on this, so I tend to not touch it. And I will tell my clients, you need to talk to somebody who does this, who offers these benefits for a living, and then they can administer those. I don't want to mess something up because I don't know enough. So health benefits, this could be medical, dental, vision. It could be an FSA. There could be cafeteria plans. So this is why I'm saying, like, I am not an expert on any of this, so I can't offer this. It's really important for, I think, the business owner to get with an expert, somebody who offers these and can help do the plan administration and help determine which option or options are going to be best for that company, for the employees, and for the budget that the company has to offer these. Traditional group plans, they provide coverage to a group of members. They usually receive insurance at a reduced cost because the risk is spread across a group of policy holders. Health savings account, this is a tax deductible savings account used with an HSA qualified high deductible health plan. So if you have a higher deductible, you want to maybe start socking money away so that you can cover those deductibles, or your employees can. We have flexible spending accounts. This is a type of savings account that provides the account holder with specific tax advantages. Again, you can find a lot more about all of this, by doing your research or talking to somebody who really is an expert in offering these benefits. An HRA is a health reimbursement arrangement. This is a notional defined contribution plan. It's set up by the employer for the employees to cover any medical expenses. And then we have the QSEHRA. Do you love all of these acronyms? This is a health coverage subsidy plan designed for employees with businesses that have fewer than 50 full-time employees. And you can look up all the limits on these and find out all the details if you need to. An ICHRA is an individual coverage health reimbursement arrangement. It's a newer type of one that started in 2020, and employers of any size can reimburse employees for some or all of the premiums that the employees pay for health insurance that they purchase on their own. There are cafeteria plans. This is an employee benefit plan that allows staff to choose from a wide variety of pre-tax benefits. They could include HSA, FSA, group term life insurance, disability, adoption assistant plans. There's a lot of different choices there. And then we're going to get into a little bit of disability benefits. So short-term and long-term disability, there are two types, right? We have short-term, long-term. And you, again, always want to talk to an expert to determine which benefit aligns with the industry, the type of organization that you are. And some employers, their benefits plan offers both. Employees can apply for short-term disability or long-term disability. For instance, my sister just had her knees replaced a couple years ago, both of her knees replaced back to back. And so she took a short-term disability leave to go through the surgery and all of the physical therapy that required. And I like to tease her about her new knees. Like, can your new knees go up this hill, Kristen? Can it go down this hill? So it's very fun to make fun of her because I don't have my knees replaced. And also she's my sister. I like to tease her. Anyway, but she's really excited about her new knees, like, because they work really well compared to the old ones. Anyway, there's also retirement plans. The Department of Labor has the Employee Retirement Income Security Act that offers two types of retirement plans. There's a defined benefit plan, which promises a specified monthly benefit at retirement, and then a defined contribution plan. It does not promise a specified monthly benefit at retirement. Basically, the employer or employee or both can contribute to that individual account under the plan at a set rate, or sometimes 5% of annual earnings. They're generally invested on the employee's behalf and eligible at retirement. And then there's retirement plans. We have 401k, we have 403b, we have the SEP, and then we have a simple IRA, right? So that SEP means Simplified Employee Pension Plans. Most people just call them a SEP. 401k, according to per the IRS, with a 401k, they can choose to defer some of their salary. Instead of receiving that money in their paycheck, the employee defers or delays getting that money. This deferred money generally is not taxed until it's distributed. So until they cash out the 401k. It is, there's pros and cons, and I think you should research the pros and cons of each one of these and talk to somebody who knows what they are doing. But pros and cons, you can read there. This includes any employees that are over 21 years old and those who have worked at least 1,000 hours in the previous year. The employee contributes via salary deferrals, and the employer may contribute a certain percentage, right? Up to X amount percentage of the salary or the wages. Contribution limits in 2022, it's $20,500, and if over 50, there is a catch-up contribution limit of $6,500. Any filing requirements, you have to file the Form 5500 is required. There is a 403b plan. This is a tax-sheltered annuity plan, and it is a retirement plan offered by public schools and certain charities. So there's pros and cons. I'm not a big nonprofit, so I can't speak to this one at all. But the employee contributes, and the employer may match up to a certain percentage. Same limits as a 401k, and the same filing requirements. They require that Form 5500. We have a simple IRA. This allows employees and employers to contribute to traditional IRAs set up for employees. It's ideally suited as a startup retirement saving plans for small employers that don't currently sponsor a retirement plan. Again, pros and cons of these. Like I said, just research it and figure out what's going to be best for the employer and the employee, and also what's going to be available within the employer's budget. Employer must contribute and employees may contribute. The matching contribution by employers for a simple IRA is 3% of compensation or 2% non-elective contribution for each eligible employee, and there's no filing requirements for the employer. The SEP plan, this provides income at retirement by allowing employers to set aside money in retirement accounts for themselves and their employees. Again, there's pros and cons to each one of these. I can't stress enough, talk to somebody who is an expert about all of these retirement plans. For a SEP, they're going to the employee is going to do salary deferrals. The employer may contribute or may not. They're not required to. And then contributions cannot exceed the lesser of 25% of the employee compensation or 61,000 for the year 2022. And there's generally no filing requirements for the employer. Okay, so that's a lot, right? So what retirement plan typically does not have a filing requirement? 401k, employer pension, 403b, SEP, or SDC, which I don't even think we talked about, a simplified direct contribution. I'm going to mute, take a sip of water. I'll come back and give you the answer in a minute. Okay, I'm going to close this poll in 3, 2, 1. And the answer here is the simplified employer or employee pension, that SEP plan, does not have a filing requirement. Home stretch, understanding some fringe benefits. These are considered compensation in addition to the wages paid to employees. So this is one of those things where you're not going to remember this. I have been doing payroll since I was 13, which is a really long time ago. And I still have to look up a lot of this stuff. So don't worry about memorizing this. Most fringe benefit rules and exclusions are in the publication 15B, the IRS 15B publication. We're going to zip through most of this because, again, this is a lot. I don't expect you to remember every single thing. I don't. I have to look it up every single time fringe benefits comes up. So dependent care assistance, this program allows employees to use tax-free dollars to pay for childcare or elder care expenses if they're incurred because the employee or employee spouse are both fully employed. So there's some examples of eligible and ineligible. So you want to take a look at that. And the benefit is $5,000 if you're a single parent, $5,000 for a married couple filing a joint return, and $2,500 if you're married filing separately. There's a cell phone reimbursement. Per the IRS, the value of the business use of an employee-provided cell phone, provided primarily for non-compensatory sorry, is excludable from employees' income as a working condition fringe benefit. Cell phones provided to promote goodwill, boost morale, or attract prospective employees will not be eligible to be excluded from employees' wages. So the value of a cell phone is going to be considered additional compensation. So if the cell phone is given to the employee for them to do their work, and it's not their primary cell phone and they get it back, this is how I understand it, I could be completely wrong, then it is not, then it's excludable from their income. However, if you just say, hey, I'm going to give you this cell phone just so that you can have it, a really nice cell phone, then that is going to be considered income to the employee. Meals provided. The IRS has pretty complicated rules with respect to employer provided rules, which are taxable. Again, I'm not going to go into this. This is one of those things where you have to really look this up. So meals provided to the employee that have so little value that they can be excluded from the employee's income. Meals provided to the employee on the employer's premises that are provided for the employer's convenience are excluded. Maybe it's super busy season, so you as the employer, you have lunch catered in. That's excluded. You don't have to consider that in income. but meals that are provided to the employee that are furnished on non-work days or with lodging are generally not excluded from the employee's income. So I've never seen that last one happen. So that's why I can't, I'm just not good at like figuring this out because I don't ever have this situation happen. Usually if a client has an employee that's traveling, they're paying for all of the travel expenses. And so, and I just don't have a lot that are paying for it. So if the meals are furnished on non-work days or with lodging, they're considered income. So just FYI with that. They're so complex and they're so confusing sometimes. A de minimis fringe benefit is one for which, considering its value and frequency with which provided, is so small that basically doing the work to account for it is unreasonable or really impractical. It could be maybe like you have an employee who uses a copy machine, or maybe prints something out personally. Maybe they have something for their kid that they have to print out. Snacks, coffee, donuts, etc. Occasional tickets for entertainment, holiday gifts, flowers, fruit, books, under special circumstances. The IRS does consider the personal use of a company vehicle a taxable non-cash fringe benefit. So employers must calculate the value of this and include it in employees' wages, and withhold the necessary taxes. Again, go check out that publication for any of the details about this. And there's different ways to calculate that: the cents per mile, the computing rule, the lease value rule. Again, I'm not digging into the details of all this. I just want you guys to be aware. These are some of the things that you need to consider when you're working with your clients. The IRS does have exclusion rules that apply to benefits that any employers provide to their employees for personal transportation, such as commuting to and from work, as well as parking. The de minimis transportation benefits, they can't exceed $21 per month. And then there's qualified transportation benefits, and you can exclude up to $270 per month. Educational reimbursements and allowances. Employers are allowed to provide up to $5,250 in educational expenses as a tax-free benefit to their employees. This includes undergraduate as well as graduate levels. Anything under that $5,250 is considered taxable income. There may be exceptions. If you receive assistance over that $5,250, it's included from your income if the education is a qualified working condition fringe benefit. Cash benefits and gift certificates. Cash is generally intended as a wage, and it usually provides no administration burden to account for cash. Therefore, it is not a de minimis fringe benefit. An exception is provided for the occasional meal or transportation money to enable an employee to work overtime. The benefit has to be provided so that the employee can work in an unusual extended schedule. That benefit is not extendable for any regular scheduled hours, even if they include overtime. Meal money is calculated on the basis of the number of hours worked and is not de minimis and is taxable fringe. Gift certificates. Cash or cash equivalent items provided by the employer are never excludable from income. An exception applies for the occasional meal or transportation fare to allow an employee to work beyond the normal hours. Gift certificates that are redeemable for general merchandise or have a cash equivalent value are not de minimis benefits and are taxable. Okay, moving and relocation expenses. Per the IRS, even if your business has an accountable plan for distributing and keeping track of these moving costs, they are still taxable to the employee. So if you pay for them to move, it's a taxable benefit. Other optional fringe benefits: achievement awards, adoption assistance, athletic facilities. Those are all considered taxable income. So if you're offering that, I have a client who has a gym membership for all of her employees, and that is considered, it's added to their wages. Home stretch, preparing deposits and returns, payroll compliance and reporting. It is one of the most regulated functions in the organization because it has to meet federal, state, and any local jurisdiction requirements. Every business organization They every organization requires businesses to make sure they do accurate tax withholding and payroll reporting. They have to pay employees timely and meet the requirement of any wage and hour laws. They have to ensure proper withholding from wages of child support and garnishments, and they have to ensure that new employees are eligible to work within the U.S. So there's two deposit schedules for federal taxes. They're monthly or semi-weekly. This is going to depend on how big the payroll is. And then employers have to deposit federal unemployment tax for any quarter in which the tax due exceeds $500. So the tax has to be deposited by the end of the month following the end of the quarter. And employers have to use EFTPS, that electronic funds transfer, to make all federal deposit. I have some client who just had to write a check. The IRS didn't send it back. They weren't able, for whatever reason, to do EFTPS. So they just wrote a check, and the IRS said, okay. Deposits and timing. Employers have to adhere to the federal unemployment deposit schedule. Any failure to do so can lead to penalties. Penalties are calculated using a 4-tier scale, and it's calculated by the number of days that the deposit was late. So they're determined using calendar days starting by the due date of the liability. We already kind of went over all of this form, so this is the second time we're seeing this slide, so I'm just going to skip right to the next one here. Payroll tax forms. The 941, this is an employer's quarterly federal tax return. This is due after every quarter, and it's going to be due. I'm not going to walk through each section, but just know you have to file this every quarter. It's due the month following the end of the quarter. We have the form. The Schedule B determines if you deposited your federal employment tax liabilities on time. If you're a semi-weekly scheduled depositor and you don't properly complete and file your Schedule B, the IRS may propose an averaged penalty. The 944, this is designed for the smallest employers, those with an annual liability for Social Security, Medicare. So basically, instead of filing quarterly, you're going to file a 941 annually. If you have just a little bit of payroll. 940, this is the annual federal unemployment tax return. So this is due at the end of the year. We have a Form W-2. Again, this is an annual. This is basically this is what you give your employees so that they can file their income taxes. This is, basically saying here, this is what you were paid. Here's all your wages, tips. This is what you paid in for federal income tax. This is what was paid in for Social Security, Medicare, all of that good stuff. It's also going to show the state wages and the state taxes as well. Form a W-3, this is basically a summary of all of the W-2s, and you're going to file this with all of those W-2s. And then you have various state filings, including income tax, unemployment tax, any local taxes. Workers pay their state income taxes. Employers are going to pay the state unemployment taxes. Those rates differ by state, and some states don't even they don't have federal withholding. So last poll, because we're done, basically, that's it. This is definitely not a right or wrong answer. This is just a, hey, what do you think? Would you like to learn more about QuickBooks Payroll? I want to subscribe. Yes, I would like a demo, or no thanks. I'm going to pause for just a second, take a sip, and then we'll shut it down. So I'll give you guys a second. Okay, I'm going to close this in 3, 2, 1. And that's it. I want to thank you guys for hanging out with me. Like I said, fire hose. I appreciate all the time that you guys are spending with me. And just make sure to research everything, because there's a lot when it comes to payroll. See you guys.